Have you ever wondered why we use animals to talk about the stock market? A charging bull, a swiping bear? It sounds a little random, but trust me, it's not. These aren't just Wall Street buzzwords. They're actually a code that explains the huge emotional swings between wealth and fear. So in the next few minutes, we're going to crack that code together.
Here's the game plan. First, we'll get on the same page about what these terms actually mean. Then, we'll look at the heart data to see which animal has really had the upper hand over the years. After that, we'll dive into the psychology of it all. Why we make some pretty classic mistakes. And then we'll build a simple playbook to help avoid them. And we'll wrap up with the one key idea that might just change how you see the market's ups and downs forever.
All right, first up, let's head into the Wall Street animal kingdom. What are we really talking about when we say bull and bear?
Well, the origin is actually surprisingly simple. It's all about how they attack. A bull, right, it thrusts its horns up in the air, a perfect symbol for a rising market. And a bear, it swipes its massive paws down, which is a pretty great metaphor for a market that's falling. It's a really powerful kind of primal image when you think about it.
So, officially, a bull market kicks off when the market as a whole goes up by 20% from a recent low point. But it's way more than just a number. It's a feeling, a vibe. Bull markets are all about optimism, confidence. They feel like they can go on forever.
And the bear is just its polar opposite. A 20% drop from a recent high, that's when you know a bear has shown up. And the feeling here is fear. Total pessimism takes over. Investors get spooked, and the selling just starts to feed on itself.
Okay, so now we've got the definitions down. But what does history tell us? Let's go to the tail of the tape and see how these two markets really stack up when you actually run the numbers.
And this is where it gets really fascinating. The data shows this incredible imbalance. The average bull market lasts about 3 times longer than the average bear market. But just look at those returns. Bulls, on average, climb about 150%, while bears only fall around 35%. The big takeaway here is just undeniable. Historically, the good times have been way longer and much more powerful than the bad times. I mean, when you see it laid out visually like this, it's not even a fair fight. This really shows the massive advantage of long-term optimism. Yeah, the downturns are sharp and they feel awful, but that long-term trend of growth has historically been a much, much stronger force. And just how high can a bull market run? Well, get this. The longest one we've ever seen, from 1987 all the way to 2000, delivered a total gain of 582%. That is just a staggering example of what can happen when growth and optimism keep going for more than a decade.
Okay, all this brings us to the most important part, the investor's mind game. Because markets aren't just numbers and charts. They're driven by people, by us. Our fear, our greed, and our overconfidence. That's the real fuel for these massive swings.
And this old saying is the absolute key to winning that mind game. It's about time in the market, not timing the market. So many of us try to perfectly predict the exact top to sell or the absolute bottom to buy, but honestly, that's a fool's errand. The real secret to long-term success is just staying invested through the cycles, not trying to outsmart them.
In fact, our emotions are so predictable that an economist named Hyman Minsky actually mapped them out. It always starts with some new, exciting thing. Then comes the boom, when everyone rushes in. That leads to pure euphoria, where it feels like prices can only go up. But then, the smart money starts quietly heading for the door. Right before the final stage, total panic, when the bubble pops and everybody tries to sell at once. Sound familiar at all? And these predictable emotions lead us right into making the biggest mistakes. In that panic stage, people sell at the bottom, which just locks in their losses. And during the boom and euphoria stages, we chase hype, driven by FOMO, that fear of missing out, and we get dangerously overconfident. Both are just a recipe for disaster.
So, how in the world do you avoid falling into these emotional traps? Well, you build a strategy for all seasons. Think of it as a simple, time-tested playbook that helps you navigate both good times and bad times with a clear head.
So your toolkit really has 3 main things. First, diversify. You've heard it a million times, don't put all your eggs in one basket. Second, use dollar cost averaging. This just means you invest the same amount of money on a regular schedule, no matter what the market's doing. It's so powerful because you automatically buy more when prices are low and less when they're high. And finally, the hardest tool to use. Stay calm and focus long term. Just tune out the daily noise.
And that brings us to our final and maybe most important section, the inevitable cycle. If you remember only one single thing from this whole explainer, please make it this.
Here it is. Market cycles are inevitable. They are not a bug in the system, they are the system. And here's the most crucial historical fact. After every single bear market we have ever had, a bull market has always followed. Every single time. Downturns are not the end of the story. They are just the transition to the next chapter.
So that leaves us with one final question, and this one is for you. It's not a matter of if your portfolio will go through these cycles, but when. You will absolutely experience both the charge of the bull and the retreat of the bear. The real question is your strategy built to withstand both?
Don't forget to subscribe to the channel, like the video, and click on the bell icon to turn on notifications.